10-year note yields seem to have built themselves a new range. Recall the first quarter we saw 10-year note yields range between 260 and 280. And ever since the March FOMC, things headed south. And now we're starting to establish a pretty clear range between 240 and 260, hovering at the close of this week at around 253. We've made an attempt to get back into the old range. We've failed. And now over the last week or so, we've seen sort of a push lower, technically starting to build, seeing yields creep up, seeing lower highs and lower lows. So right now we're kind of gearing up towards a move back towards 240. It's not going to happen overnight, but from a technical perspective, bonds are looking pretty bullish here, especially since they faded that 260 attempt to get back into the old range not too long ago. So right now, from a technical perspective, we are seeing yields remain stubbornly low and looking to push even lower over time. And market volatility, while it tends to be very kind of uneventful as we head into the summer historically, not a lot of big things going on, especially with the Fed on hold. But volatility eerily staying unchanged, kind of hovering right on that 14-day moving average. It does that from time to time before it tanks back towards the lows, which we have been seeing recently over the last few months. We get up to the 14-day, we fade it, we go back to the lows and back and forth and such. But right now we're kind of creating a trade of a sideways trade. I think the market right now, like many of us, are wondering how much lower yields can go in bonds. Likewise, what is Fed policy going to have to do with what's happening? Are jobs in the U.S. going to be the only thing that remain positive? Are we going to see anything else from over in Europe, China, or whoever that can push these markets around, and can equities continue on their path? So right now, with all those questions and all those uncertainties, volatility is starting to show a little bit of uptick. And when I say uptick, it really means it's not going down. And essentially, we're starting to see some concern priced into volatility, not fear. We aren't in any kind of fear right now in any asset class that we can see, but certainly it's maybe eyebrow raising, we can call it. Lastly, let's look at what we did find out today in the jobs report. Yeah, jobs are strong, unemployment's low. That hasn't ever been the problem going back for, I can't tell you for how many years. We've had plenty of jobs. The concern here is average hourly earnings and what people are getting paid, and that inflation component, which remains low. We saw the bond market rally in the face of a very strong jobs number, given the fact that inflation just isn't there. That is going to be the Fed's thorn in their side. And I think that even though we have inflation contained, the Fed right now wants to talk up the potential for higher rates down the road. We heard from several Fed speakers today, all of them kind of jumping on saying, yeah, we're very happy where rates are. We're looking forward. We're not looking for lower rates. Inflation will be contained. It won't be a problem. They tend to like to talk their way out of a problem before the problem actually gets there. And I think right now, if you look at those Fed fund futures, they're telling a little bit of a different story with lower rates headed into year end, and then maybe possibly 1 to 2 rate cuts between now and the end of 2020. So I think at this point, the Fed has got to wait and see if they can get some inflation, if they can continue to see the growth numbers they have, if the housing market can turn around. And globally, you've got some issues in Europe and China that probably will drag down global growth, which is obviously going to hurt us at some point. So I think right now the Fed needs a little help. 10-year note yield suggesting that there are buyers, there is demand for treasuries, and volatility hovering kind of in a midpoint area and not going lower says that maybe the market's looking for some kind of breakout. And if that breakout comes, it looks like it could come to the downside in yields. So 10-year note yields go out of the week sort of in the middle of the range, but now starting to lean towards possibly testing the lower band, something we haven't done in a long time.